Earlier in my career, I worked in Sarasota, Florida. I worked with a lot of elderly clients, and I was dealing with death on what felt like a weekly basis. What I learned back then fundamentally changed how I approach retirement income planning today. See, the IRS punished surviving spouses over and over again. And what I found is expenses barely budged, but the tax bill went through the roof. In a time of grieving, they were also getting hit with significantly more in taxes. I'm Brennan Decima, owner of Decima Wealth Consulting and certified financial planner. In today's video, I'm going to go over the surviving spouse tax trap. We're going to cover what it is, why so many people fail to see it coming, and what you can do today to get in front of it. All right, so here's what it is. When you're married, you typically file jointly, and married filing jointly has wider tax brackets. You also have higher standard deduction, so the IRS gives you a benefit for being married. But then all of a sudden, one spouse passes, and you go from married filing jointly to single filer. And this is where it starts to get ugly. Single filers have much tighter tax brackets, which means the same amount of income is going to be taxed at a higher rate. On top of that, the standard deduction is going to drop as well. But here's where it also hurts. Expenses are rarely dropping by a meaningful amount when one spouse passes. Mortgage and rent isn't going to go down by half. Utilities aren't going to go down by half. Property tax typically stays the same. Groceries may change a little bit, but that's not going to move the needle materially. So you have a spouse that's just lost their partner. They're grieving, they're overwhelmed, and now all of a sudden they're finding out that they have a massive tax surprise waiting for them. This is something that I think about a lot. If I'm no longer here, what would I want for my wife and kids? And how would I want an advisor to work with them? And this is at the crux of everything we do here at Decima Wealth Consulting. It's putting a plan together that not only maximizes quality of life while we're here, but puts our loved ones in a much better position in the event that we pass. And that's why the spousal tax trap gets me so fired up. So let me paint the full picture. Tax bracket compression is just the start of the tax trap. When one spouse passes away, the smaller Social Security benefit drops. So expenses barely move, but predictable income is reduced. So for most people, that means more of a dependence on their savings. And if retirement income planning is not done right, that means more of that draw needs to come from a tax-deferred account, like an IRA or a 401k. But because they're single filers, that distribution is coming out at a higher rate. So what might have been a 22% tax rate when you were filing jointly, now all of a sudden that surviving spouse is having the money come out at 32%. And it doesn't stop there, because you also have, if you're Medicare age, the possibility that these distributions are causing a higher Medicare IRMAA. So same healthcare coverage, but just maybe more expensive for the surviving spouse. And there's nothing worse than sitting across the table from someone who just lost their loved one and saying, "How is this possible? My income went down, but my taxes went up." And the reality is the tax code is just not designed with your best interest in mind as a surviving spouse. All right, so what can we do about it? This is where strategic planning at the front end of retirement can make a massive impact on setting up your surviving spouse when you're no longer here. And there's really three things to think about. Number one, Roth conversions if you're in a lower bracket on the front end of retirement. And this does a couple things. One, while you're still filing jointly, a Roth conversion is taking money out of a tax-deferred account and moving it to a tax-free account. So if you know that you're in the 22 or 24% bracket, but when you pass, your spouse is going to be in the 32% bracket, Roth conversions are filling up those buckets to create more flexibility for your surviving heir. Each dollar converted to a Roth and the growth from that dollar is no longer in the required minimum distribution. So if there's a big expense on the back end of retirement or a big need for income, that Roth account is going to give them much more flexibility. Also, those withdrawals from the Roth account are not part of the Medicare IRMAA calculation. Number 2, consider exploring Social Security claiming strategies as a couple. And what this typically looks like is the higher earner spouse defers their Social Security until 70. And this does a couple of things. One, it gives a larger amount of wiggle room to get money out of a retirement account into a Roth while you're deferring. So a bigger Roth conversion bucket. Number 2, each year you wait, your benefit grows by 8%. So if you pass, that creates a bigger guaranteed income for your surviving spouse. Not only does this provide peace of mind, but it also reduces the amount they're going to need to withdraw from their savings at a compressed single filer rate. And number 3, diversifying your tax buckets. There's 3 types of money. Number 1 is money that you've already paid taxes on. Think bank accounts, brokerage accounts. Number 2 is money that you have never paid taxes on, employer plans, traditional IRAs. And number 3, tax-free money, think Roth. Well, a surviving spouse that has all of their money in a tax-deferred account, bucket 2, money they've never paid taxes on, there's not a lot of options, there's not a lot of flexibility if a major expense comes up and they're filing single. Someone that has that bucket 1 or bucket 3, there's a lot more flexibility. So while you're filing jointly, there's a lot more opportunity to spread those buckets out, creating flexibility for the surviving spouse. At the end of the day, this is much more than just a conversation about taxes. It's about putting together a plan to make sure our family is taken care of in the event that we are no longer here. In a time of grieving, it is already incredibly overwhelming. There's a lot of tears, there's a lot of unknowns, and saddling our loved ones with a massive tax surprise only adds to that pain. We cannot control what happens or when it happens, but we can prepare accordingly and get in front of it. Consider sharing this with someone that you care about, and if you're looking for more retirement planning videos, please subscribe. I'll see you in the next video.